Why markets move before the news. One of the most common questions investors ask is why markets seem to move before major news is released. Stocks rally ahead of positive announcements, fall before bad headlines appear, and often react very little when the news finally breaks. To many people, this feels unfair or even suspicious. But in reality, this behavior is a normal and essential feature of how markets work. To understand why markets move before the news, we need to understand what markets actually trade. Markets do not trade facts. They trade expectations. Every stock price reflects millions of individual beliefs about the future. Investors constantly try to anticipate what will happen next, not just next quarter, but next year and beyond. By the time news becomes public, markets have already formed a view about its likelihood and potential impact. Prices move when expectations change, not when information becomes official. Most news is predictable long before it is announced. Economic trends develop gradually. Inflation rises over months. Growth slows over quarters. Corporate earnings follow patterns. Central banks signal intentions long before they act. Professional investors spend their time analyzing these trends and adjusting positions well in advance. When the news finally arrives, it often confirms what the market already believed. This is why markets frequently react less to major announcements than people expect. If an interest rate cut is widely anticipated, markets may rise weeks or months before it happens. When the cut is announced, prices may barely move or even fall because the event is already priced in. The market's real reaction happened earlier. Markets also move before the news because information flows unevenly. Not all participants process information at the same speed. Large institutions, analysts, and professionals continuously interpret data, guidance, and subtle signals. Their actions gradually move prices as expectations evolve. This does not require inside information. It is the result of constant analysis and positioning. Markets are always aggregating countless signals long before headlines appear. Another reason markets move early is positioning. Once investors expect good news, they buy. Once they expect bad news, they sell. By the time the news becomes public, many investors are already positioned for it. When everyone who wants to buy is already bought, there may be no one left to push prices higher. This is why markets sometimes fall on good news. This phenomenon is often described as "buy the rumor, sell the news." Market psychology also plays a major role. Fear and greed peak before the news, not after. As anticipation builds, emotions intensify. Once uncertainty is resolved, even if the outcome is negative, relief can lead to stabilization or rallies. Markets dislike uncertainty more than bad outcomes. This is why clarity, even bad clarity, can support prices. News itself is also backward-looking. Economic reports, earnings releases, and policy announcements describe what already happened. Markets, however, are focused on what happens next. When data confirms a trend that has been visible for months, it adds little new information. Markets move on surprises, not confirmations. This dynamic explains many apparent market contradictions. Stocks can rise during recessions because investors expect recovery. They can fall during strong growth because investors expect tightening. They can ignore terrible headlines if conditions are improving at the margin. Markets are not reacting to today's world. They are pricing tomorrow's. Understanding this concept is crucial for investors. Those who wait for confirmation from headlines often arrive too late. By the time news feels safe, prices have already moved. This leads to frustration and the belief that markets are irrational. In reality, markets are doing exactly what they are designed to do: discount the future. In summary, markets move before the news because they trade expectations, not events. Prices reflect anticipation, positioning, psychology, and changing probabilities long before headlines appear. Once you understand this, market movements stop feeling mysterious. The news explains why prices moved. It rarely causes the move itself.